Okay, good morning, class. And today, what we are actually going to talk of is we're going to talk of the term structure of interest rates, term structure. Okay, so let's proceed with it. Right. So, what we are basically going to discuss on this is we need to talk of the yield curve, the expectation hypothesis, and segmentation hypothesis. Okay, so these are the three things that we're going to talk of. Right, so let's start with yield curve. Now, what is yield curve? Yield curve is a graphical representation, right? Graphical representation of what? Of the interest rates on the debt for a variety or a range of maturities. And it shows the yield that an investor is expected to earn if he's lending his money for a given period of time. And the graph actually displays the bond's yield on the vertical axis and the time to maturity across the horizontal axis. Okay, so see this? The terms to maturity on the horizontal axis and the interest rate on the vertical axis, and this is the yield curve. Okay. So, but the curve, what happens is it may take different shapes at different points of time in this economic cycle. Usually, it is upward sloping. And a fixed income analyst may use the yield curve Y as a leading economic indicator, especially when it shifts to an inverted shape. Inverted shape, I'll show you a little while later, which actually shows that there's an economic downturn where the long-term returns are usually lower than the short-term returns. Okay, so this is a typical yield curve. So types of yield curves. First is the normal, which is the most common shape of the yield curve, and hence it is referred to as normal curve, right? So what happens in a normal yield curve, it reflects a higher interest rate for 30-year bonds as opposed to 10-year bonds. So your long-term bonds are higher, they give higher interest as compared to short-term bonds. So what happens if you actually think of it? What happens if you think the logic behind it? If you're lending money to someone for a longer period of time, you would expect a higher return or higher compensation for that, right? So this is what is a normal yield curve, which I showed earlier also. And so it's a positively shaped yield curve. It's the normal curve, because what happens in a rational market, in a rational market would generally want more compensation or more risk. If you take more risk, you want more compensation. So what happens in terms of long-term securities, they are exposed to greater risk because it's a longer period of time. So the yield that you get will always be greater than that of what is offered for lower risk short-term securities. Okay, so and a long-term period of time increases the probability of some expected negative events taking place, because you don't know, the economic cycle is not stable, it's not static, it's dynamic. Changes are happening, so there can be some negative shocks happening, so the risk is higher. So obviously what will happen is people would, if you want to invest in a long-term securities, you would want to have higher compensation coming up. So obviously what happens is, so long-term securities, they offer higher interest rate, and because they have higher volatility is the risk that happens, like it could be a profit, there's a chance of loss also, high risk. Okay, the second type that we have is inverted. Inverted curve is just appears when what happens is when the long-term yields, they follow below the short-term yields. And when does this happen? When we have that opinion, we have the perception that interest rates will decline in the future where long-term investment is concerned. So those who want to invest for long-term, they have that feeling, looking to the present scenario, that the interest rates can fall, it's going to decline in the future. So it can happen for a variety of reasons. But the main reason is the expectation of a decline in inflation. So it's going towards deflation, right? So when the yield curve starts to shift towards an inverted curve, it's an indicator. It's a prime indicator that there is an economic downturn downturn, right? And so such interest rates changes have historically been reflected, have reflected the market sentiments and the expectations of the society that curves. That interest rate changes that shows what about the market, it predicts about the market and the expectations about the society, of the economy, right? So see, this is a inverted yield curve, right? So where it's best to go for a short-term investment in this case. Third type is a steep curve, which indicates that long-term yields are rising at a faster rate than the short-term yields. Now, what happens up here is short-term yields have historically indicated what? When you have a not short-term, but sorry, the steep yield curves, they have indicated that it's a start of an expansionary economic period, right? So that's the indication. Steep yield curves shows that indicates that it's the beginning of an expansion in more economic period, and both the normal and steep curves are based on the same general market conditions. But the only difference is that when we talk of a steeper curve, it reflects a larger difference between short-term and long-term expectations, right? Normal curve also shows that long-term expectations, they give higher yield, higher yields are coming. But when you have a steep curve, so the difference between short-term returns and the long-term returns, that's much higher. That's the difference. See this? This is a normal curve, and steep curve is, see, it's much more steeper. So the difference between the long-term and short-term yield returns, the yields, is much higher. Fourth type is what we call as a flat curve. Flat curve happens when all the maturities have the same yields. What does that mean? That the yield that you get from a 10-year bond is exactly, essentially, it's the same as that what you get from a 30-year bond. So what does that mean, and when can that actually happen? So flattening of the yield curve happens when there is a transition between the normal yield curve and the inverted yield curve. So when from an economic downturn, it becomes the normal situation comes, right? So that change, when that comes up, when the economy is reviving, from coming back to normal situation, so that change, when that change is happening, so then you have a situation comes when that transition happening, that where all the maturities will have the same yields. This is how it goes, right? Fifth one is what we call is a humped yield curve. Humped yield curve happens when the medium term yields are much higher than that of the short term yields and long term yields. So but it's a very rare case, because medium term yields getting more than short term and long term. Short term is understandable, but from long term, so it's a very rare case, right? And it happens, what it usually happens when there is a slowing of economic growth. When the economic growth starts, so the rate of growth starts slowing down. That's when it happens. It's a rare case. See, this is how it goes. This is a hump, right? So what are the influencing factors? First is inflation, right? So we all know this, that central banks actually, what happens, they usually tend to respond to a rise of expected inflation. How? With an increase in the interest rates. We've learned this earlier, where rise in inflation, what happens? It will decrease the purchasing power, and so investors expect an increase in the short-term interest rate. So inflation means that's one they feel that the short-term interest rate is going to go up. Economic growth. Now, when there's a strong economic growth, it leads to an increase in inflation. Why? Because of increase in aggregate demand, right? And when you have a strong economic growth, it also means that there is competition for capital. Competition for capital means more options to invest, which is available to investors, right? So when you have a strong economic growth, it also leads to an increase in the yields and a steeper curve. That's when we have the steep curve. Third is interest rates. Now, if central bank if they raise the interest rate on the treasuries, treasury is the treasury bills, which are short-term bills which the government issues. So this will again lead to a higher demand for treasuries and ultimately lead to a decrease in the interest rate. So, what are the importance of the yield curve? First is to forecasting of interest rates. Now, shape of the shape of the yield curve, it actually helps investors to have a sense, right? Like what would be the future course of interest rates. When we have a normal upward sloping curve, which means what? That the long-term securities have a higher yield. Inverted curve, you should know that, where short-term securities have a higher yield. So, right? Second comes up is financial intermediary. All the banks and any other financial intermediaries, they borrow most of their funds. How? By selling short-term deposits and lending. They lend by using long-term loans, right? So steeper the upward sloping curve, wider is the gap between the lending and the borrowing rates, and higher is the profit. So steeper curve means what? There's a gap between the short term and the long term returns. So short term, they sell short term deposits, right? And they to get money, and they lend long term loans. So when you have, they get more returns. So the returns becomes higher, right? That's why the steep curve. And a flat or a downward sloping curve, on the other hand, what does it mean? That there is a decrease in the profits of financial intermediaries, right? Third, the trade-off between maturity and yield. So the yield curve also helps to indicate the trade-off between the maturity and yield, right? If the yield curve is upward sloping, then what happens? To increase his yield, the investor will invest more in long-term securities, which means more risk, right? Overpriced or underpriced securities. Yield curve also indicates to the investors whether a security is temporarily overpriced or underpriced. And what happens is, if the rate of return from a particular security, right, actual rate, it lies above the yield curve. What does that mean? That security is underpriced because the yield curve is much less than the actual rate, right? Whereas on the other hand, if the rate of return is below the yield curve, right? So what does that mean? Yield curve is what you get. That means the security is overpriced, right? One is what you get and what you actually have to get. So if the actual rate of return is below than what you get, that means that security is overpriced because you're getting more. And just the opposite happens if the rate of return is higher than the yield curve. That means what? You're getting actually less. So it's underpriced. So these are some of the yield curve theories. One is the pure expectation theory, which actually assumes that various maturities are substitutes, and the shape of the yield curve depends on the market's expectation of future interest rates. So according to this theory, what happens is yield tends to change over time. But what happens is this when we talk of pure expectation theory, this theory has failed to define the details of the yield curve shapes. So, and it also ignores the interest rate risk and reinvestment risk. We'll go into interest rate risk and reinvestment risk a little later. Liquidity preference theory, which is an extension of the pure expectation theory, and in whatever you have in the pure expectation theory, but there's an additional factor, which is a premium, which is called liquidity premium or term premium. So where the theory considers that greater risk is involved in holding long-term debts over short-term debts, so the premium is higher, right, for long-term. Third is segmented market theory. So it's which is based on the fact on the separate. It says that there is separate demand and supply relationship between short-term securities and long-term securities. So it is based on the fact that different maturities of securities cannot be substituted for one another. See, pure expectation says that it can be substituted. Here, segmented market theory says it cannot be substituted. Why? Since investors generally prefer short-term maturity securities over long-term maturity securities. Why? Because the former, in case of short-term maturities, the risk is less, whereas as compared to long-term securities. So what will happen? So price of short-term securities will be higher, and the yield will be less, right? So price is always high. Prices are higher because the rate of the returns that you get is less. So that's why the price is higher. Okay. Fourth comes up is preference habitat theory, which is an extension of the market segmentation theory, which says that investors prefer a certain investment horizon. To invest, they prefer a certain investment, the time period where they want to, how much they want to invest for how much period of time, right? To invest anything outside this horizon, they will require some premium. If you want them to invest for a longer period of time or in some other type of investments which they are not willing to, so you have to give them some incentives, right? So it actually, this theory also explains the reasons behind long-term yields being greater than short-term yields, because you want someone to invest for a longer period of time, you have to give them more returns, right? So what is the yield curve? As we said, it's simply the difference between the short-term and long-term rates. Okay, so short-term rates, it's usually two-year bond. They are greatly influenced by central bankers of any country, with an attempt to stimulate the economy, to support employment, to control price inflation. Whereas on the other hand, when we talk of long-term rates, they are totally controlled by the market and forces, any other forces which is associated with supply and demand. Okay, short term is central bank, long term is market and the forces, supply and demand forces. So what happens under any normal circumstances, rates are higher for long term debts, we just explained. Why? Because of the additional risk which is involved with the money that is tied for a longer period of time. So it makes sense, that if a person who wants to be paid more interest when their money is committed for 20 years as opposed to two, so there 20 years, a lot of things happen, there are more risk, so obviously they should be getting more, they should be paid more interest. So this extra interest that we get from the long term debt is called yield premium. This is the premium that they get. So what is this? And in this, implicit in this concept is the presumption that the economy will grow over the next 20 years, and there also will be future opportunities to put money to work, which would result in future earnings, appreciation of stocks, and receipt of bond interest. So these opportunities are lost when a person's money is committed to another investment, right? So this is the opportunity cost, and that's the most important thing. So if you invest for a long period of time, there's always result that you can earn more, right? And interest, you can get more interest. So that opportunity gets lost, right? If you as an investor, you invest in some other type of it, you want to invest your money in some other places, so that's the opportunity cost. So, and to compensate that, when they're investing, that's why that extra premium is given, that yield premium is given. So when the difference between short term and long term interest rate is too high, that's where we say that we just discussed earlier that the yield curve is steep, right? So a steep yield curve, it suggests what does it, that there is a potential for future economic growth. There's enough scope, which means what? That it requires a significant premium in the form of higher interest payments of money, right? Money which needs to be committed when someone is investing in a long-term, yeah, long-term investment comes when someone invests their money, right? So, for instance, bond. So when the difference between the long-term and short-term is short-term rate, long-term, short-term rates is small. So that's where we have the yield curve is flat, right? So which means what? The market does not see future growth opportunities, and then they're willing to commit money in the future for same or similar rates that are available today, right? So they don't want to go for more a longer investment, so right now. So okay, so what can happen, like, so yield curve can invert, if the yield curve can invert and short-term interest rates become higher than long-term interest rates. So that's where it happens when the difference is very less. Okay. So why is it at all of this that we're talking is important? Because of two reasons. First and foremost is when we talk of yield curve, it gives us an insight into what the investors see within the economy as a whole, right? What do they see? If you as an investor, if you believe that in the efficiencies of free markets, then what happens? That's what then the aggregate opinion of all the market participants is the best evidence of what is going on. Everyone is thinking of it, right? Right. Okay. So what happens is basically if the market is not main thing to see is if the market is not seeing opportunities for growth in the future, so we need to pay some attention in that, right? That is the best thing. When there's no future growth, then one has to be very careful, one has to pay more attention when you go for investment, that do you really want to go for a long-term investment? That won't be the wise thing. So when it's a normal thing, when it's growing, then it's always fine, then it's not a problem. Okay. What's the second reason? Reason like why yield curve is important? Yield curve has a great impact on the supply of money within the economy, right? So if you can explain it in a different way, that is, yield curve influences the ability of the individuals and businesses to obtain the bank loans. Banks borrow money, as we said, banks borrow money at short-term rates, either from its depositors or from the central bank's discount window. They get it. Central banks lend money, right? And then what happens? In turn, when they get married, it would actually the banks would then loan money to people like common people like us at a higher rate, right? Higher rate than what they have borrowed. The borrowing rate will be lesser than the lending rate, right? And if the market is not requiring higher rates due to concerns about future growth, then what will happen? Where then the banks are forced to loan money at lower interest rates when there's no future growth potential, like if the future may not be that uh, doesn't look so good, right? So in that case, what happens? The bank cannot make so much money and the margins are less. So it's very much what happens in this case. The flatter the curve, the less incentives banks have to make loans, right? So loans are a risk for a bank in this case. And if it can't make money for assuming the risk, banks quit taking the risk and quit making loans. And if banks stop making loans, so what happens? Consumers and businesses also cannot borrow, right? They cannot borrow. So economy suffers. People can't buy their houses, cars, businesses cannot reinvest, economy starts stagnating. So in what does it mean? That the yield curve thus becomes a secular fulfilling prophecy, right? In many ways, like yield curve says what is going to happen in the future. Next comes up is expectation hypothesis, right? Expectation hypothesis. What's it? It's a expectation hypothesis of the term structure of interest rates, where is it says that the long-term interest rate is determined purely by the current and future expectation of short-term rates, by how the looking into the present as well as the future expectation of the short-term rates, we can talk, right? We can talk about the long-term rates, how it will be going. So how is it done? It's done in a way that the expected future value of wealth when you invest in a sequence of short-term bonds is equal to the final value of wealth from investing in long-term bonds. Expected final value when you invest in multiple or sequence of long short-term bonds is equal to the final value of wealth that you invest in a long-term bond. So it's that's what they say, right? The sum of all the short-term bonds that you get, the returns that you get, that's equal to the long-term investment. It's the same. And the graphical representation of expectation hypothesis is the yield curve, right? So in this hypothesis, we assume that various maturities are perfect substitutes, and it suggests that the shape of the yield curve depends on market participants' expectation of future interest rates. So these expected interest rates, along with an assumption that arbitrage opportunities will be minimal. Arbitrage opportunities means simultaneous buying and selling of assets in the securities in different markets when there is a price difference, right? So assumption is that that opportunity is minimal. That is enough information to construct a complete yield curve, right? So expected rates along the and the concept of arbitrage opportunities. And this theory is consistent with the observation that yields usually move together, all yields, right? So it states that the current price of an asset is equal to sum of expected discounted future dividends conditional on the information known now. So the current price is equal to the sum of expected future dividends, right? Based on the information that you have. So it's basically it's used to predict interest rates, and it's based on the idea that long-term interest rates can help to forecast the short-term interest rates in the future, right? It's also sometimes used as an explanation for the yield curve, right? And what happens is, yield curve, where it says that it's a, what is it? Yield curve, it's a line plotting the interest rates of bonds with different maturity dates, but the same credit quality. But this has been found to be inaccurate. So the basic idea behind the theory is that expected value of investing in a sequence of short-term bonds will be the same as investing in a long-term bonds. That's what we explained a while ago. So what happens is, if you as an investor, you want to invest in 1 year bond and then again roll it into 1 year bond after a year, the you will earn the interest that you will earn, right, would be same as if you were purchasing a 2 year bond initially, right? But what happens is, the theory has shown to overestimate the future interest rate. They overestimate it. It does not take into account the risk of investing in bonds. That is not taken into account. So the shortcomings of the expectation hypothesis, it neglects the risk, as I said, risk in when you invest in bonds, because uh, forward rates are not perfect predictors of the future rates, right? So when we talk of these risks, as I was telling you earlier, that there are two types of risk: interest rate risk and reinvestment rate risk. So we'll explain what this is. There are two types of risk which the expectation hypothesis neglects. First is interest rate risk, which is the risk that arises for any bond owners due to fluctuating interest rates. How much interest rate a bond has, it depends on how to what extent is the bond like price sensitive. Okay, how sensitive its price is to the changes in the interest rates in the market. So the sensitivity of depends on two things: the bond's time to maturity and the coupon rate of the bond. Coupon rate is the interest that you get from the bond, right? So it varies. The risk varies. Risk depends on like the time of maturity and how much interest you're getting. So we know rate of interest is inversely related to the price, right? So that's how it comes up. Second comes up is the reinvestment rate risk. So it's a risk that a particular investment might, there's a risk that a particular investment can be cancelled or stopped at some point, right? And that one may have to find a new place to invest that money, with the risk being that there might not be a similar attractive investment available. So reinvestment, right? You may have to just withdraw your money, invest somewhere, but you may not get the same type of returns, right? This happens when this basically happens if bonds are paid back earlier than expected, right? You get back your money earlier than what you expect. Yeah. So this is just a quick recap of the expectation theory, which expectation theory, it attempts to predict what short-term interest rate will be in the future based on the current long-term interest rates, right? And it also suggests that an investor earns the same interest by investing in two consecutive one-year bonds investment versus investing in a 1 2 year bond today. So instead of rolling in twice for 1 year and 1 year, if you invest in for 2 years, it's the same you will get. So this is theory is that's why it's also called unbiased expectation theory, right? Now, expectation theory predicts the future short-term interest rates based on the current long-term interest rates, as we said. And it also suggests, as we said, that an investor earns the same amount of interest by investing in two consecutive one-year bond investments versus investing in 1 2 year bond today, right? So, in theory, what it says that long-term interest rates can be used to indicate where rates of short-term bond will trade in the future. Looking into the present long-term interest rates, it can predict what will be the short-term interest rates. And this particular theory aims to help investors to make decision, right, based on the forecast of future interest rate, where it should invest. This theory also uses the long-term interest rates, right? Long-term interest rate is usually that's coming from the government bonds to predict or forecast the rate of short-term bonds, as we said. So long-term interest rates are used to indicate where rates of short-term bonds will trade in the future. So we use it that. And the theory actually aims to help investors to make decisions. How do you make? By using long-term interest, long-term rates. Long-term rates, as I said a while ago, that comes from the government bonds to predict, to forecast the rate of short-term bonds. So what are the disadvantages of this theory, right? So investors should be aware that expectation theory is not always a reliable tool. So what is there's a common problem here when you use it, this theory, that it actually, it sometimes tends to overestimate the future short-term rates, right? So what happens is, because you're looking into the present scenario statics, predicting, so it can overestimate. So what happens? It actually happens that results in the investors actually ending up with making an inaccurate prediction of the bond's yield curve, right? The other limitation that comes up is that there are many factors which impact the short-term and long-term bond yields, right? Central banks reserves adjust interest rates up and down as it happens in time, increase or decrease, which also impacts the bonds yield, including short-term bonds, right? But in case of long-term yields, they might be less affected because there are many other factors which impact the long-term yields. That includes the inflation and economic growth expectation, not just the banks' reserves. The banks' reserves, central banks' reserves, the interest rates, where they adjust the interest rates. Not just that, but it could be also inflation and economic growth expectations. So as a result, what happens is when we talk of expectation theory, it does not consider these outside forces. These are the outside forces. And some other fundamental the macroeconomic factors which actually influence the interest rates and ultimately the bond yields. So it does not do it. So how do you calculate the expectation theory? So let's look into that. Let's say that the present bond market has two options for an investor. Investor can invest in a 2 year bond which pays an interest of 20%, right? And there's also an option where the investor can invest in a 1 year bond which pays an interest of 18%, right? So what is expectation theory? What do we know? At looking into the long-term interest rate, we can predict the short-term interest rate. So we will use this theory to forecast the interest rate of a future 1 year bond. What will happen there? How do we do? So how do we actually calculate? The first step is like we add 1 to the 2 year bonds interest rate. So 20% means 0.2. So adding 1 plus 0.2 is 1.2, then next step is when you get 1.2, you square it. So 1.2 into 1.2, that is 1.44. Now you divide this result by the current 1 year interest rate. What is the current 1 year interest rate? That is 18%. So 1.44 divided by, how do you, 18% means what? 18% means 0.18. So it's, so for 1 year, then what does it mean? It's, if the actual price is 1 and you get an 18%, it's 0.18. So the total amount is 1.18, right? So 1.44 divided by 1.18, right? And then you add, put it in brackets, plus 1. So it will give you 1.22, right? So 1.22 means what? To actually, if you want to find out the interest, like 1.22 is not an interest, to actually forecast the 1 year bond interest rate for the following year, what do? 1.22 minus 1, that is 0.22, that is 22%, right? So what does it say? That the investor is earning an equivalent in return to the present interest rate of a 2 year bond. 2 year bond is getting 20, it's 22%, right? So the investor, if the investor chooses to invest in a 1 year bond at 18%, so what will happen? The next year, the bonds, what the bonds, the investment, the interest rate, that if they invest in that 1 year bond, the interest rate would increase to 22% for this investment. And so what? It is always advantageous to go for this type of this investment rather than a long-term interest investment, right? So now what is happening? The expectation hypothesis that we're talking of, it states that we also said that different term bonds can be viewed as a series of one-term bonds with yields of each period bond equal to the expected short-term interest rate for that period. But you should actually note, there's a point to note here, is that the expected future interest rates are just that, expected, right? There's no reason to believe that that's going to be the actual interest rates, especially when you talk of extended forecasts. When you go on predicting that will happen next year, it will happen next, it will happen. So right, so it's expected rates, but still, it's despite that expected rates still influence the present rates. So according to this hypothesis, if the present expected rates are expected to rise, right? Present, if the future expected rates, expected interest rates are, you expect them to rise, then what will happen? The yield curve slopes outward, with longer term bonds paying higher yields. But if the interest rates for the future, if you expect the future interest rates to decline, then in that case, this will cause the long term bonds to have lower yields than short term bonds, which results in an inverted yield curve. It's how you predict here, looking at the present situation. So, inverted yield curve often results when short term interest rates are higher than historical averages. Whatever it is the average, it's higher, since there is a greater expectation that the rates will decline. So long-term bond issuers would be actually reluctant to issue bonds with higher rates when the expectation is that the lower rates will prevail in the future. So when you want to buy bonds for long-term investment, they are not willing to give you higher rates of interest. And the expectation hypothesis, it helps to explain two of the three characteristics, not all three, but two of the three characteristics of the term structure of interest rates. So the first two, right? So where it says the yields of bonds of different terms tend to move together, right? How? Because the theory says that the bonds of all maturities are perfect substitutes, right? And so the theory actually can explain movements together by short-term and long-term interest rates, since long-term interest rates are simply an average of short-term interest rates. So they tend to move together. Second is short-term yields are more volatile than long-term yields, right? That's the second thing. But the third structure, as a third characteristics cannot be explained. What's the third one? That this particular hypothesis does not explain why yields on long-term bonds are usually higher than short-term bonds. bonds. Why is it higher? So this could be explained by the expectation hypothesis only, like if the future interest rate was expected to continually rise, which isn't always possible to say, nor has it been observed except in certain brief periods, right? So that's the reason, right, why it could not explain that why long-term bonds are having higher yields. It only if the future, if you can say it is going to increase continuous, that's the only way, right? But you cannot say, there's no way to say it, right? And short-term means why it's more volatile, because anything can, which you're actually predicting the looking into the long-term situation, you're actually talking the short-term means. So short-term means can vary. You can have because it's what does it say that the long term yields is where it's coming when we're talking of more stability, more risk is there, so the returns are also high there, right? So it's much more stable. Here what happens is it's yields it's more, it fluctuates, it's more fluctuating on this short term yields, right? Where long term it's much more stable, stability comes into play. So, next, segmentation hypothesis. Next, what is segmentation? Segmented market theory states that the market for bonds is segmented on the basis of the bond's term structure, and segmented markets operate more or less independently. So the theory says that the return offered by a bond with a specific term structure is determined by the supply and demand for that bond, solely by that, and it's totally independent of the returns offered by bonds with different term structures. So expectation hypothesis theory says that they're perfect substitutes. Segmentation hypothesis says no, you cannot substitute them. And when we talk, the segmented market theory was actually introduced by the American economist John Matthew Culbertson, who, in his paper, The Term Structure of Interest Rates in 1957, what he said, he developed his own theory of how fixed income securities are priced by the market. So, what is term structure? We've been talking of term structure. It's also known as the yield curve when you represent it graphically. It's a relationship between the interest rate paid by an asset, usually government bonds, and the time to maturity. And as we've seen earlier in the diagram, interest rate is measured on the vertical axis and the time to maturity on the horizontal axis. So normally, interest rates and time to maturity are positively related. More time, more is the interest. Short time, that's less, and that's why volatility in the short term in investments, right? So interest rates rise with an increase in the time to maturity, right? So and it results in the term structure taking a positive slope. So yield curve is often seen as a bond market's measure of confidence in the economy, right? How it talks about like what will be the future of the bond market, whether it's wise to invest in the bond market. So yield curves actually tells us. See this? So this is where we set the graphical representation interest rate on the vertical axis, time to maturity, and the yield curve, right? It's increasing means what? That it's wise to invest for long term. Long-term investment is better than short-term. So, the segmented market theory states that the bond market is full of heterogeneous agents with different income needs, right? Different types of people with different income needs. So, different agents in the bond market will invest in different parts of the term structure based on their needs, right? And banks usually tend to mainly participate in the buying and selling of short-term bonds, right? How it's mainly done to due to the we know this the modern practice banking practice of fractional reserves, keeping a portion of the deposits as reserves and lending the rest, right, in the short-term bonds, buying and selling. Whereas when we talk of pension funds, it's usually involved in the buying and selling of long-term bonds. Why? Because that's where we talk of the stable income requirements. Long-term is, as we said, it's more stable. So stable income requirements of the pension funds, right? Because pensioners' money. So, according to the expectation hypothesis, we said the return on any long term fixed income security must be equal to the expected return from a sequence of short term fixed income securities, right? So, any long term fixed income security can be recreated using a sequence of short term fixed income securities. That's what we said, right? If you invest in short term bonds, like short term securities, in 1 year, then 1 year, and whatever we get. And if you invest straight away in a 2 year security, we will get the same thing, same return. But segmented market theory says that long-term fixed income securities and short-term income fixed securities are totally different and cannot be put in the same class of assets, right? Why? Because these are totally different things, and it's totally, as I said, it has their own, it is each of these types of these inner securities are totally determined or influenced by the demand and supply for that particular type of investment. So in general, what happens is the holders of long-term bonds need to worry about a lot more things than the holders of short-term bonds. So, for instance, what happens if someone is holding a 10-year US government bonds? It could be any government. Need to worry about inflation for the next 10 years and the interest rate for the next 10 years. Whereas if someone is holding a 1-year bond, need to worry about inflation for the next period and the interest for the next period. That's why I said it's more fluctuating, right? Because in one short span of time, anything can happen. 10-year, it's much more stable, things get better, like it's more time. So for a 10-year bond, right, it has a very different fixed income, it's a different type of fixed income instrument, and as compared to a 1-year bond, right? And a 10-year bond cannot be recreated using the sequence of, like, you invest 1-year bond 10 times, 10, and what you get, and when you invest in a totally first time investing in a 10-year bond, that cannot be the same thing, it's totally different. So market segmentation theory is a theory that long and short term interest rates are not related to each other, so it's unlike the expectation hypothesis. It also states that the prevailing interest rates for short, intermediate, and long term bonds should be viewed separately, right? Like items in different markets for debt securities. These are different types, so it has to be viewed separately. And it also, this theory also states that long-term and short-term interest rates are not related to each other. Why? Because they have different investors, different type of investors. You cannot relate it. So this theory's major conclusion is that yield curves are determined by the supply and demand forces within each market or category of debt security maturities. Like short term will be determined by the supply and demand for the short term market, and long term is long term market. And the yields for one category of maturities cannot be used to predict the yields for a different type of maturities. You cannot do that. So market segmentation theory is the other name, is also called segmented market theory. So that's a belief is that the markets for each segment of bond maturities consist mainly of investors who have a preference for investing in securities with specific durations. Market segmentation means the market is divided into different types of investments: short, intermediate, long term. So they have categorized, and we have different types of investors who are in these three categories. So there's no link, they have their own preferences, right? And this theory also says that buyers and sellers who make up the market for short term securities have different characteristics and motivations as compared to those of intermediate and long term maturity securities. They have their own needs. And the theory is partially is also based on the investment habits of different types of institutional investors, say banks and insurance companies. Banks generally would favor short-term securities, insurance companies would go for long-term securities. Okay, so implications for the bond, for the market analysis. What's the implications? The yield curve is a direct result of the market segmentation theory. Traditionally, what happens is the yield curve for bonds is drawn across all maturity length categories, right? Yield, which reflected a yield relationship with long-term and short-term interest rates. But for all the advocates of the market segmentation theory, they suggest that when you examine a traditional yield curve covering all the maturities length, it's a very fruitless endeavor. Why? It's not a good practice. It's because short-term rates are not predictive of long-term rates. We cannot just actually plot and find the relation. It is actually difficult, so we cannot do that. So it doesn't make sense. We cannot actually um, predict the future, right? Okay, so that's all that we have from here, right? And if there's any other question, we will discuss it in the next class, right?